All right, welcome to our breakdown from Talk Tickers. Today, we're diving deep into TopBuild's third quarter earnings. Now, on the surface, everything looked pretty good, but the stock actually took a hit. So we're going to figure out exactly why. So here's the central puzzle, right? TopBuild came out with a beat and raise. That's exactly what Wall Street loves to see. They beat earnings expectations and they raised their guidance for the future. So why on earth did the stock immediately drop? That's the mystery we're solving today. Let's dig into what the market saw that made everyone so nervous. Okay, first things first, let's just look at the headline numbers. These are the big, splashy figures that pop up on everyone's screen the moment the report comes out. And yeah, on the surface, they look pretty solid. Revenue came in at about $1.4 billion, which just edged out what the analysts were predicting. And the adjusted earnings per share, $5.36. That's a nice, comfortable 8-cent beat. So on paper, you're looking at this and thinking, great, this is a win. But, and this is the big but, the market had a totally different reaction. The stock dropped almost 3% in pre-market trading. And that's your first major clue, isn't it? It tells you that the real story, the one that actually matters, isn't in the headlines. Something else was going on under the hood that really spooked investors. So, okay, let's start peeling back the layers of this onion. We need to look at how TopBuild got to that growth number because, and this is so important, not all growth is the same. Far from it. And wow, this chart right here, this tells you everything you need to know about the quarter. Just look at this. The growth they got from M&A, that's mergers and acquisitions, was a huge plus, almost 8%. But then, look right next to it. Their organic volume, so the actual sales from their core existing business, that was down almost 7%. The tiny bit they got from price increases barely made a dent. So what does that mean? It means all of their growth was bought. It wasn't grown from within. Now, to be fair, the CEO, Robert Buck, didn't really hide from this. On the earnings call, he was pretty upfront about it. He acknowledged that their main residential market is weak right now, but he pointed to their strength in commercial and industrial. And where is that strength coming from? Well, you guessed it, it's coming from the very companies they just bought. And this really gets us to the heart of management's whole playbook. They know their main market is struggling. So the big question is, what's the game plan? How are they going to steer the ship through these choppy waters? Well, their strategy is what we in the business call a roll-up and mix-up grade. It sounds a little jargony, but it's pretty simple, really. They're on a shopping spree, buying up other companies. That's the roll-up. And they're doing it to intentionally change what their business looks like. That's the mix-up grade. They're trying to get away from being so dependent on the roller coaster of the housing market and move into more stable areas like commercial and industrial projects. Make no mistake, this is a huge pivot for them. And listen, they are not messing around here. We're talking about major deals like Progressive Roofing and SPI. These acquisitions alone are adding something like $1.2 billion in annual revenue. That's just massive. They're literally reshaping the entire company with these moves. And management couldn't have been clearer about their priorities. Number one on their list with a bullet is strategic M&A. That is where they believe they can drive the most value. After that, it's giving cash back to shareholders. And they did just that, buying back over $65 million of their own stock this quarter alone. So you bring all these new companies into the fold, what does that do to your forecast? Well, it's exactly why they were able to raise their guidance for the full year. Higher sales, higher profits. And you really have to catch this detail. They were very clear that this guidance raise in the beat and raise is coming entirely from the companies they just bought. It's not because their original business is suddenly doing any better. Okay, so let's put it all together. What do we really have here? We've got a core business that's kind of struggling, but it's being papered over by this really aggressive acquisition strategy. So where do we land on this? What's our official verdict here at Talk Tickers? Well, it really comes down to a classic bull versus bear debate. The bulls, the optimists, are saying, hey, management knows what they're doing. They'll integrate these new companies perfectly, the diversification will pay off, and it'll be a huge win. But the bears, they're worried. They're saying, what if that core business gets even worse? And what if the benefits from these deals just don't show up fast enough to fill that gap? It's a real tug of war in thinking right now. All right, so before I give you our official call, I just want to make sure we're all on the same page about what our ratings mean. When we slap an outperform rating on a stock, it means we expect it to beat the broader market, think the S&P 500, over the next 12 months. Simple as that. So, with all of that said, our official rating on TopBuild is outperform. And let me tell you exactly why. There are 3 big reasons. First, we have confidence in this M&A strategy. We think it's absolutely the right move for them right now. Second, this isn't their first rodeo. This management team has a fantastic track record of not just buying companies, but making them work, all while protecting their profit margins. And finally, that pivot into commercial and industrial, it just gives them a much-needed layer of defense against the wild swings of the housing cycle. It makes the whole business much more resilient. So really, it all boils down to this one single critical question. It's almost like a race against time. Can TopBuild's powerful acquisition engine build this new diversified company fast enough to outrun the slowdown in its old legacy housing business? That right there is the story you need to be watching. And just a quick reminder, of course, this is for informational purposes only and should not be considered financial advice. Thanks for tuning in.